is going to share some strategies on taming the tax beast. Anybody in the room prefer to pay more taxes versus less taxes? Not seeing many hands dart up. He's the founding partner of SBLR LLP Chartered Accountants. SBLR is focused intently on helping business owners minimize tax while protecting and growing assets. His approach to business is about a lot more than accounting, I can assure you. I've known our speaker for some time, and he brings 25 years of experience in helping business families and corporations implement strategic tax planning. And today he's going to share a few of those ideas with us, and I'm sure a few other things along the way. Please join me in warmly welcoming Mitch Silverstein of SBLR.
Good morning, everybody. Very, very nice to see you. First of all, I just want to, well, we're just getting some props brought out here. I just want to thank Emma and Andrew and the whole team, Jeremy, for, first of all, picking this great event for us to be involved with, and also this venue. I have to share a secret with you. I am a musician, and I always wished that I could perform on this stage. I never thought that I'd be starting off that performance career with a discussion on tax, but at least it's one step onto the stage. So, and I have a very, very important question to ask before we get started. Is there anybody here that works for the Canada Revenue Agency? I see no arms going up. Okay, good, because if somebody put their arm up, I was going to have to completely change my presentation. But I think we're good to go. Okay, so what I decided to do today is, because tax can be a very theoretical discussion, and so I decided to do a little bit of a case study. So with your permission, we're just going to talk about a couple of facts of a business. Okay, here's our case study, folks. Mr. A owns 100% of ABC Company, which he bought in 1996 for $500,000. At the time, the business was growing about grossing about $5 million and earning about $100,000 of net profit. Obviously, that's where Mr. A saw some opportunities. Under Mr. A's tutelage, the company has grown and now has revenue of about $12.5 million, pre-tax profit of $600,000. That's after a salary to Mr. A of $300,000. ABC has retained earnings on the balance sheet of about $1 million. He believes that the company is worth about $2 million today, assuming, of course, that he gets to draw out that retained earnings before the sale. Mrs. A left the workforce a number of years ago, but income splitting at its finest, folks. Again, Canada Revenue Agency is not in the audience. She receives a salary of $50,000 from the company. The A's have 4 children. They're 21, 19, 17, and 14. The 2 older kids attend university out of town. And not surprisingly, and in concert with today's event, Mr. A would like to sell out in 5 years. He wants to sell the company for at least $6 million cash, and none of the 4 children have demonstrated either any inclination or, frankly, any ability to be the purchaser of the company. Okay, so that's our case study facts. I don't know if that necessarily resonates with your businesses, but it will give us an opportunity to take the theoretical information and apply it to a set of facts. Okay. I'm actually going to break with tradition and skip the small business deduction for right now, and I'm going to come back to it in a couple of minutes, because the first thing that I want to do is, I am an accountant after all, and so what I want to do is I want to do a little tax calculation. Let's assume that Mr. A is successful in building up this business, and 5 years from now, somebody actually shows up with $6 million in a briefcase. Would be a great thing, wouldn't it? Okay, so we're going to do a little tax calculation. I'm going to pull this out here, so that hopefully everybody can see what's going on. Okay, so, and you can help me out. For those of you who are really good in math, you can help me out with this. Let's assume Mr. A does sell the company for $6 million, right? So everybody knows how capital gains work. When you sell shares of a company, you're going to have a capital gain. So what was the cost base of those shares? Remember back from our case study? You can yell it out, or I'll help you if you want. $500,000, great. So the cost base is $500,000. That means that he's got a capital gain of, well, before we do the capital gain, how many people know about the capital gains exemption? How many people have heard of that? Right, great. All small business owners, terrific. So when you sell the shares of a qualifying small business corporation, you get to save tax on a certain amount of the capital gain. The history was, it was $500,000 initially, then it got raised to $750,000. So we're going to have a cost-based deduction of $500,000. We're going to have a capital gains exemption of $750,000. So we're going to have a capital gain of, I'm waiting, $4,750,000. That's fine. I'll help you out. Now, we know that capital gains are taxable at what percentage in income? half the capital gain is taxable. If you buy $1,000 worth of Coke shares in the market and you sell them for $5,000, you have a $4,000 gain. Only $2,000 of that gain, half, gets added into your income and gets taxed at your personal marginal rates. Same thing happens when you sell the shares of your company. So the taxable capital gain is approximately $2,375,000. And based on the tax rates in effect today, the tax that Mr. A would have to pay on this transaction is approximately $1.1 million. All right, now, $1.1 million as a percentage of $6 million, not necessarily a bad percentage. How many people in the audience that own businesses would like to write the check for $1.1 million to the Canada Revenue Agency? And I am, oh, somebody actually raised their hand, that's good. I guess it means you still have some money left over, but it's still a lot of money. And we're not even talking about whether they do good things with the money that you've sent down to Ottawa or not. Efficiency is going to be left off the table for purposes of this discussion. Okay, so now, let's also understand that the current structure of Mr. A's company, because he's been really busy building a business that was grossing a relatively low amount of money when he bought it to $12.5 million today. So Mr. A, here's our wildly complex corporate structure. Owns 100% of ABC Company, right? That happens a lot of the time. And the reason is because nobody looks at structuring and things like that because they're too busy worrying about meeting payroll next month. We understand that. Okay, so that's the situation. What if Mr. A is not happy about writing a check for this amount of money? What can he do? Well, let's assume that the proceeds is not a variable. Let's assume that that's what the business is worth. We can't change his cost base because that's what he paid for the shares originally. Let's assume that tax law is not going to change where the 50% inclusion of a capital gain is what goes into your income. And let's assume that the marginal tax rates are not necessarily going to change that dramatically. So the only thing that we're left with, potentially in this category as a variable, is the capital gains exemption. Well, the capital gains exemption is available to each individual on the sale of qualifying small business shares one time in their lifetime. So when he uses his, not only is it gone, but he can only use one. What is a potential solution? You've heard some of the referrals to that today with our other speakers. Anybody? What can we do? Family. Add more people into the structure, right? So if we add more people into the structure, what might it look like? So we might have ABC down here. We might have what some people have referred to as a family trust. I'll call it a discretionary family trust. There might be some beneficiaries of that trust as individuals. There might be a holding company as a beneficiary of that trust, or it might be here. There's all kinds of interesting things that we can do. What if we do that? Let's assume we do that, and let's not talk about accounting, tax, and legal cost just for the minute, okay? Always good to talk about the benefits before we talk about the costs, right? Okay, so we had our scenario before where Mr. A was paying $1.1 million in tax. What if Mr. A did that restructuring at the time that the company was worth $2 million? He did a freeze. We've heard about a freeze today. So he froze the value of the company at $2 million, which was the value today, and then he builds the company up to the point where it gets sold for $6 million. What is our new capital gain and our new tax scenario going to look like? Well, we've still got proceeds of disposition here, and we've got Mr. A now is selling his special shares, his frozen shares, for $2 million, right? He froze them at $2 million. We still have a cost base of $500,000. We still have a capital gains exemption of $750,000. That means that he has a capital gain now on his frozen shares of $750,000. Half is taxable, $375,000, and the tax he's going to pay on that is approximately $170,000 tax. Now, what happens to the remainder of the proceeds? The remainder of the proceeds are on the shares that are owned by the trust that was put into place 5 years ago. Well, there's $4 million of the remainder of proceeds. Is there any cost base on those shares that the trust subscribed for? No, because all of the value is in Mr. A's frozen shares. But we now have, potentially, let's go back to our case study, Mr. A, Mrs. A, 4 kids. Let's not talk about anybody else. Mr. A's already used his capital gains exemption on the frozen shares, but we now have a wife and 4 kids, so that's 5 people. 5 times potentially $750,000 is $3,750,000. Leaves a capital gain of $250,000, taxable capital gain of half of that, $125,000, and tax of $60,000. Total under this scenario, $230,000 of tax. Which one do you think Mr. A is going to be a little bit more interested in? That's an $800,000 tax saving. Now, okay, so I've done this presentation. I'm sitting in my boardroom with a potential client. We go through all this, and of course, he's drooling because he can do a lot with $800,000, right? So he says, okay, we'll talk about cost in a minute, but should we do this? And I got to say, you know what, Mr. A, not sure. Not sure. What are you, like, giving me a cookie and then taking it back from me? He says, well, I'll tell you what. If we were having this discussion in 2007, no brainer. What happened in 2008 in the fall? What happened in 2009, 2010, and 11, and 12 to some businesses? Pretty tough sledding for a lot of small business owners. So do we know with great certainty that someone's going to show up with $6 million in a suitcase? Not necessarily. Very important to say, this is a great exit strategy outcome, but I can't guarantee the exit strategy. So please, Mitch, show me a compelling reason why I should go to the cost of reorganizing my company from Mr. A owning ABC to having a family trust and a holding company and everything else, if I can save some money or have some other benefit while I'm waiting for what I hope to be an exit strategy that saves me $800,000 5 years from now. Fair question? Let's talk about that. Okay. So this is our reality check components of the presentation, because a lot of people have accused me of having, somebody mentioned rose-colored glasses not too long ago, of having rose-colored glasses on, because a lot of companies in 2007 that were making $600,000 bottom line after $300,000 salary to Mr. A and $50,000 salary to Mrs. A is not necessarily the case in 2009, 10, 11, and 12 potentially. So I'm going to digress for 2 seconds and tell you about what is going on at the Canada Revenue Agency these days. This is a program that came into effect 2 to 3 years ago. What happens at the end of February every year for business owners? Business owners have to file something with the Canada Revenue Agency. It is the T4 summaries for all of their employees, right? Innocuous, no problem. People get salary, they get a T4, they have to pay taxes. T4 summaries go in electronically or go in by mail. What happens at CRA Canada Revenue Agency? When that stuff comes in, it gets scanned or loaded into the computers. And then what happens is they do a database sort. And the database sort is very simple. Please print out a list of all of the companies that have T4 slips issued to people with the same last name. Oh, I hear some giggles. Must be the controller for the company. And the reason for that is because that list then gets parsed up and handed out to all of the junior auditors in CRA, and the instructions are very straightforward. Please call every company that has multiple employees with the same last name on T4 slips, right? So here's what happens. The junior auditor at CRA picks up the phone, calls ABC company. Hi, can I speak to, guess, who? Mrs. A, 22-year-old receptionist, hired for the great customer relationship management skills, right? Giggles, covers their mouth and says, Mrs. A doesn't work here. You know what that is? That's an audit. That's an audit. And a big audit. And remember the old days when they used to come in and they audit income tax, but nobody knew what GST was, and nobody knew what PST was? Everything's in the same pot right now. And guess what? In 2009, when they combined the federal and provincial governments with respect to the tax collection and auditing functions, pre-2009, there was all kinds of inefficiencies at the federal level and at the provincial level. And when they combined everything, can you imagine what's going on? They're sitting around there waiting to audit your company. Okay, so great accountant Mitch, thanks very much for bringing me in for a meeting. Now you've told me I have to stop paying my wife a salary. I know why we're paying her a salary. Why? Because Mr. A is making $300,000. Mrs. A is making $50,000. If we add the $50,000 to Mr. A's salary now instead of Mrs. A, what's the tax rate? What's the taxes on those two amounts? On $300,000, the tax is $120K. On $50,000, it's $9,000. If we move the 50 over here, there's an extra $24,000 of tax. That's a $15,000 tax difference. Of course we know why Mr. A is paying Mrs. A a salary, because it's a lot more money for them. Not only that, it's earned income. We can make what? RSP contributions based on that salary. We can deduct childcare expenses. It's all good. Okay. Except it's a big risk. So what do? Mitch, if you're going to tell me to stop paying the salary and my lifestyle has to go down, I'm in trouble. Okay. So let's look at the situation. Oh, and by the way, the rose-colored glasses situation, ABC doesn't make $600,000 anymore. In 2008, it went down to $150,000. It actually lost some money for a couple of years. Now it's back up to $150,000. And my question is, what's wrong with the current remuneration structure? Let's look at our tax calculations. Right now, the company now has $150,000 of income. Small business tax rate on the first $500,000 of taxable income in a company is how much? I gave you the answer already. 15.5%. Does everybody know that? Small business rate? 15.5% on the first 500,000. That's a darn good rate, okay? Mr. A's pulling a salary of 300 grand. By the way, when business got tough, was the first thing to go Mr. A's salary, or was it something else? Was probably beating up his accountant on how much he charged him for the year-end statements. That I can promise you. Okay, $300,000 salary to Mr. A, $120,000 tax, there's $2,200 of CPP. Mrs. A's got $50,000, 9 grand of tax, $2,200 of CPP. Let's see what they're living off right now. Total net after tax between the two salaries is $216,250. Total tax and CPP payable by the company, $157,000. That's the current lay of the land. What's wrong with that picture? Inherently, small business deduction is 15.5% on $500,000 of income. We are paying $350,000 of salaries to Mr. and Mrs. A. What's the top marginal tax rate on salaries in the province of Ontario? 46.5%, beautiful. Top marginal tax rate on dividends, different remuneration style, 32.5%, very good. We got some smart people in the audience. So they're obviously overpaying tax. Why? Think about it. We are trading 15.5-cent corporate tax dollars because we have a deduction for salary expense for Mr. A paying 46.5% on receiving that salary. That's a 30-point gap in the savings the company is realizing and the tax that the personal individual is paying. Something wrong with this picture. Okay, but we need to have income, right? So what do? Okay, let's assume that Mr. A did like the idea of restructuring for an exit strategy, and so he put a family trust in place and he has some beneficiaries. Or maybe he doesn't. Maybe he says, you know what, I love my kids, but I don't want to get involved with all that. It's too much of a pain. Let's just give a class of shares to my wife, for example. So let's eliminate the salaries on January 1st of a particular year. Now what happens to the company's income? It goes from $150,000 back up to $500,000, right? Because now we don't have Mr. A's salary of $300, which is a deduction, and Mrs. A's salary of $50, which is a deduction. So $500,000, now what are we doing? We're maximizing the benefit of the small business tax rate, 15.5%. So the new tax, we now have more corporate tax to pay. It's $77,500. Now, how do we pay Mr. and Mrs. A? Well, the only other option other than salaries is dividends. How many people know, what is the, we already know the top marginal rate on dividends. If dividends is your only source of income in the province of Ontario, how much can you earn in a year without paying 1 penny of tax personally? First of all, is that even possible? The answer is yes. The answer is $35,000. $35,000, think about it. So the company pays 15.5% corporate tax on profit and then pays a dividend of $35,000 out to a family member or an investor. No tax personally on that. Interesting. Mr. and Mrs. A, if they each take $132,500 of gross dividends, the tax on that $132,500 is only $24,375. It's graduated. It's not all at the top tax rate. Bottom line is, total net after tax, exactly the same number as we started with in the original scenario. $216,250. They're living off the same amount. I can't tell them to take less money and they'll be happy with the changes in their lifestyle. They have a mortgage, they have a condo in Florida, they have a cottage in Muskoka. They can't change necessarily their lifestyle. Okay, total tax and CPP under this strategy is $126,250. Total tax savings, just under $31,000 a year, just for changing the remuneration strategy? That's incredible. And when a company is in a tough economy, and they used to make $600,000 and now they make $150,000, and we can put another $31,000 on the table for reinvestment in research and development, for investment in professional consultants to help the owner structure the business for sale. Interesting idea. Okay, let's go to the next step with the 2 minutes that I have left. Let's say he likes the idea of the family trust. $31,000 is good, but I want to transition this to my family one day. So what if we put that family trust in place? We have a family trust in place. Now I can make $500,000 in the company, pay 15.5% corporate tax, and of the remainder, which is about $422,000, I can pay dividends out on the common shares which are owned by the family trust, and that family trust can flow those dividends through to individual beneficiaries of the trust. Mrs. A, the 21-year-old, the 19-year-old, nobody under 18, by the way. There's tax law that says you pay top marginal rates if you're under 18, but we've got 2 kids over 18, that are 18 or over. How much can we pay? We pay Mr. A and Mrs. A $53,500. Taxes $3,000 only on that amount, if that's the only income. On the kids, $60,000 of dividends, $2,300 of tax. The reason? Because the tuition that they're paying at university gets claimed as a credit on their tax returns. That's all the tax they pay on $60,000. Bottom line, after tax, the same $216,250. Total payable, $88,250 versus our initial scenario, almost a $70,000 tax saving. Any questions? Yes.
Two questions. How does that work from a cash flow perspective? Can you only pay it out at the end of the year as a dividend?
No. Pay it out weekly, daily, monthly, whatever you want. As a matter of fact, I would encourage it from a creditor proofing perspective. Don't wait until somebody sues you to pay out dividends, to pay out equity.
And what about RSPs and EI?
Great question. So dividend income is not considered earned income under the Income Tax Act, and you would have to take a moratorium on making RSP contributions. However, I have found since 2008, when cash flow is tight, a lot of people built up RSP contribution room and didn't have the liquidity to make the contributions. So you can still make RSP contributions even though you're receiving dividends, but you're not building up future contribution room. Good question. Thank you. Yes? It does if you want to get the multiple capital gains exemption. It has to be in place for 24 months prior to the sale. And that's why what everybody's talking about today is planning and strategy and structure.
Yes, sir.
Right? Very good question. Thank you. It has to be in place. Always good to do it before you're ready to sell.
Mitch, fabulous. Now, I'm going to be signing up for a pair of those rose-colored glasses. See what people would say that. Thank you so much. There's a lot of power in what you've said.
Thank you.
A lot of great planning opportunities that I know I wasn't aware of. So hope everybody else gained as well.
Thank you
so much.
Thank you. Thank you very much.